What are the challenges and solutions for sustainable finance? How can financial institutions change the way they allocate financing towards greener banking? And will a move towards sustainable finance require market-based solutions or regulatory-driven changes? Financial institutions have a very important role to play in mitigating climate change and making the planet more socially and environmentally sustainable. A change in banking and investment approach that measures and rewards environmental and sustainable behaviors will encourage millions of companies to adopt sustainable practices. In this video, Rodrigo Zeidan, an economist and finance professor at NYU Shanghai, discusses these questions.
Everybody, my name is Rodrigo Zeidan. Right now I'm in Shanghai. I teach at NYU Shanghai. I also teach at Fundação Dom Cabral, the leading executive education business school in Brazil. First of all, thank you, Shay. Thank you, Sona Analytics, for the invitation to speak to such an august audience. What I would like to do today is discuss the challenges and the solutions for, broadly speaking, sustainable finance, right? And how, with Sona Analytics, I help develop something that may be, hopefully will be, a game changer in how financial institutions adequate their lending to let's be very direct, for what I term greener banking, right? The idea that financial institutions have a very important role to play in making the world a better place, mitigating climate change, and as an economist, as a finance professor, somebody who has published extensively in both scientific outlets and the media, and later this year, my 7th book, General Theory of Working Capital Management, which, by the way, has a chapter on greening supply chains. I can assure you that greener banking and sustainable finance is not an oxymoron, right? So we can and we should find ways to improve the non-economic performance of financial institutions and companies around the world. Of course, we need a diagnosis first, right? What are the problems that we face? What are the obstacles? What are the main challenges? What are the barriers that we have when we speak about sustainable finance, when we speak about sustainable lending and investing, right? And here, broadly speaking, I wanted to open by a discussion on market-based solutions and regulatory-driven changes, right? I remember when the project that started, what is now the sustainability, the Sona Sustainability Credit Score System, the SSCSS. This started as a project 2012, 2013, with a multinational bank. So there's a long story behind this project. Gladly, Sona Analytics shepherded the project into its current form. But I remember in 2015 when I turned what is the method behind what I'm going to present to you later. When I turned into an academic article, I sent it to a colleague of mine who is a German. At the time, we met while I was in Nottingham University in Ningbo in China. He was still in China at the time. I was back between Brazil, Copenhagen, and China, but in another institution. I was at a visiting professor at NYU Shanghai, where I'm a full-time faculty member now. And I sent him the paper, and he actually sent it to his former PhD advisor. His co-author in a couple of scientific articles. They have published something in the same journal, Journal of Business Ethics, one of the leading journal in business ethics globally. And he came back to me saying that his colleague, his mentor, he said that he didn't believe the type of solution and research that was proposing, because for him, only regulations, only financial authorities could lead the financial industry towards more sustainable goals. For him, no market-based solution was possible. No market-based solution was desirable. Right? As a German, he believed in the strong hands of the state in forcing banks to improve their behavior in terms of lending and forcing financial institutions to change their behavior. What is interesting is that same year, I actually mentored a German MBA student, and he actually tracked the history of environmental reporting by banks in Germany. And the reason is because he worked for a German bank, a regional cooperative bank. And he found out that in 2008, 1/3 of the German banks published environmental reports. By 2013, 2014, that number was 99%, including his bank. But he knew that his bank had absolutely no true policy towards improving non-financial outcomes. And he knew that the environmental report that his bank published was a piece of marketing, was what we call greenwashing. In other words, this was a pressure by regulators that simply didn't work. Now, as a finance professional, as an economist, as a finance professional, my goal is to improve decision making. Right? We want to improve decision making by every type of market agent possible, by companies, by investors, by governments, right? And I found it very funny to hear that an academic would only trust the government to enact solutions to improve society. I am a Brazilian. The idea that I'm going to outsource to the Brazilian government important policies to improve society is a recipe for disaster, right? And that is true in most countries in the world. Yes, maybe not in Denmark, where I teach every summer, where people can hold their politician accountable to a certain degree, but we simply cannot rely on public authorities to do what is best for society all the time. We have to do it, right? We must change the system, especially those that work within the system. By changing the system, I'm not talking about anything political. I'm talking about which kind of service we can provide to improve financial decision making, right? And it's not a coincidence that two recent scientific articles I have published, one with the Journal of Sustainable Finance and Investment, and the other with Business Strategy and Environment, both that have been published this year, so they're very fresh off the press, even though academic research is never fresh off the press in that sense, because the publication cycle is relatively long. But these two articles, they help show that there is a huge discourse for sustainable lending and sustainable lending practices. But the reality is that there is still a huge gap. Right? There is still a huge gap that we aim to fill with the SSCSS. And what is this gap? So let me talk briefly about my scientific research, because it's not really scientific research. Is very close to the practice. Right? One is more of actually is kind of a sophisticated interview with the owner of here we are. Let me show you. I'm sharing my screen. Right. It comes from an interview, structured interview that I had with the owner and the manager, the founder of a regular asset management fund. There was also a social capital fund. In which sense? Right. The idea was very simple. So they are a wealth management fund in which they attract assets, and part of these assets must be allocated in funds that generate social returns, right? And by social returns is these are the targets, right? So the funds, the right capital social impact strategy is related to these 10 goals expressed in the UN's Sustainable Development Goals, right? It's very simple. Of course, most of their clients' wealth is not going to be directly tied. It's going to be mostly tied to regular investment products, but part of it must tie into the Sustainable Development Goals. Okay? Which means, and that's what is interesting about this article, which means that Right Capital, they are not a supplier of sustainable lending. They are a consumer. In other words, they represent their clients and they allocate part of their clients' funds, and which means that they represent their clients' interests, and they must track the performance, the regular performance, right? The ROI, return on investment, rate of return, whatever measure. But they also must track the non-financial impact of part of the investments of their funds, 5, 10%, of the capital that they have under management. And the question is, they cannot do it properly. And the reason is because there is no standardization of non-financial metrics. Most of you have most likely heard about ESG scores, environmental social governance scores. They are non-financial metrics that have been created more or less in 2005. So they are 15 years old. And today there are, and I'm not joking, 1,000 accounting standards based on ESG. ESG is non-standardized, is mostly self-reported data. The larger companies will report data with more details. There is a huge incentive to disclose good data, not disclose bad data. Then you have databases such as RepRisk, reputational risk, that try to track reputational events or negative ESG events. Still, we do not have rankings or scores of companies that are not regular credit ratings, right? There are some for large and listed companies, right? So we have stuff like Sona Analytics, companies that have done a very good work of creating scores based on publicly available data for listed companies. But there is a problem. What about the other 99.9% of companies in the world that are privately owned companies and that do not disclose non-financial information? They are not required to disclose non-financial information, right? That's where commercial banks come in. Commercial banks, at the end of the day, they are responsible for allocating capital around the world. And they do it by creating credit scores for the companies that they lend. And that's where we come in, right? But before we talk about this, before I talk about the genesis of the SSCSS, I want to make clear that there are many important challenges. The SSCSS tackle one of them. But at the end of the day, we won't have climate change mitigation without market-driven greener investments. It's as simple as that. We cannot rely solely on regulation to tell banks, oh, you should lend to company A but not to company B. You should increase provisions for environmental risks. You should make stress tests for climate change. That is not enough. This is necessary but not sufficient condition to mitigate climate change. We need proactive lending behavior. Right? We need a framework that integrates sustainability into funding and credit products. That is created by the market, that is driven by the market, and that becomes a standard. And that's where market dynamics come into play. Today, we have many providers of credit ratings, but we all know who are the largest ones: Moody's, S&P's, right? We know who these companies are. And the reason that they are the largest is because they develop standards that out-competed other standards. And now they are recognized as the standards by which, if you wanna launch a bond in the Chinese market, you need a rating. You hire one of these companies, you get the rating, and that's it, right? And after a while, these companies will create ratings for large companies. Again, capital markets are humongously large. The world is drowning in liquidity. We need mechanisms to allocate this capital efficiently into more sustainable investments. I am in China. China was the first country to create green bonds. And in the beginning, everything was a green bond. Today, that's not the case. That's how standards evolve. Right? In the sustainability index of the Dow Jones, fossil fuel companies, if I'm not mistaken, they were part of the sustainability index in the beginning. They are not anymore. That's how standards evolve over time. But there is still one product lacking in the market. And that product is what we're going to talk in the next session, which is about sustainable lending and investment in detail, about how commercial banks operate, the incentives by account managers, and all of that. But let's stop for now. I hope it's clear that we need financial markets to evolve. We need environmental standards to coalesce. We need ESG to become more standardized. For a while, competition is good because the bad indicators die. Hopefully, the more robust survive. But it's now 2022, it's 17 years later. We need better products and better methodologies to make sustainable lending a larger part of financial markets. Okay, that's all for now. See you in a bit.